We are so honored. On short notice, she came in today. Rebecca Patterson is with us with all of her work at Bridgewater over the years and, of course, at Bessemer Trust as well. What does boring, quiet money do, given the shock of a 256,000 statistic? Woe is me, doom and gloom America. Forget about it. What does quiet money do this year?
I think quiet money is already invested in equities, and as long as the consumer is holding in and they have jobs and the confidence to spend, and today's data says they do, then I think you can stay in equities. Now, given valuations, the upside's going to be a little more limited unless we keep getting positive surprises. The challenge, I think, is where do you go in the equity market, right? Small cap initially rallied on the Trump win, thinking deregulation, lower rates, it's going to be great, and they've given back all of those gains from right after the election because of rising yields. Small cap needs strong growth and lower yields, and right now they're not getting enough of both.
Lisa, thanks for doing that report. Sweeney was occupied. I saw him on the phone with his realtor.
Yeah.
I got a 30-year bond, 4.99%. Wow, Paul, does that change the landscape?
It does, Tom. And we got big movement on the front end of the curve. The 2 years up 10 basis points, 4.36% there. So, Rebecca, how do you think the Fed is going to digest this data that we received today? Because, boy, the labor market looks pretty solid.
Yeah, I mean, I agree with Ellen, who was just on before me, that a January pause is baked, fully baked.
Okay, gotcha.
And now the market is discounting that the first, or next, I should say, cut, or the first cut this year doesn't come till October.
Yeah.
Who the heck knows, right? It's going to depend on all the policies that get rolled out. If the economy slows, if something cracks with the upper income consumer to hurt their confidence and cause them to pull back spending, this picture can change. If immigrants fall sharply, wage costs go up. That could, I mean, there's a lot of variables that could move us in either direction. So to me, an October cut doesn't seem crazy. I'm more interested right now in what's going on in the long end. Okay. The 10-year yield going up, pushing up mortgage rates, which is hurting the housing market, but also what's causing it. Right, and we should talk about term premium.
Well, we're going to do that right now. We're going to talk about term premium because Dr. Patterson said, Tom, we're talking about term premium. Look, let me cut to the chase. You have been vetted as a Fed governor, a president, I don't know, somebody, carrying coffee at the Eccles building, whatever. You've been vetted, Rebecca Patterson. This live tweet says it all. The last cut was a mistake. It killed the Santa rally. Fold the last cut into your concern about rising yields.
Well, it's fascinating that as the Fed has cut 100 basis points, the 10-year yield has gone up more than 100 basis points. It's highly, highly unusual. What I'm worried about now is if the rise in yields is not a reflection of growth. I think today's move right now on the 10-year is stronger labor markets, so a higher Fed funds rate and strong growth. That's not a bad thing. But if the 10-year is going up because of uncertainty around policy, around Fed independence, around inflation, then you are going to see rising yields hurting stocks. And we've seen that pattern over history. That's what I'm worried about. Not the level of the yield, what's causing the rise in the yield.
Well, just to that point, Torsten Slok, just in a matter of minutes, was out with a little note here. Higher for longer continues to be the key theme in markets. Higher for longer in the front end because of the strong economy. Higher for longer in the long end because of a strong economy and fiscal worries, which goes to your point. So I guess that kind of goes to the question, when are higher interest rates a real problem for stocks?
Again, psychologically, maybe if we crack 5%, that could do some damage in a short-term basis. But I think the bigger deal is going to be, again, what's causing it. I'm watching things like economic surprise index. Okay. If growth surprises are disappointing, that's bad for term premium, i.e. term premium goes up in a bad way. If inflation expectations, we have data Monday, we have CPI coming up. If those things are moving in the wrong direction, and also earnings. Look what these CEOs and CFOs are saying. If they're highlighting fiscal worries, if they're highlighting rates, that could get reflected pretty quickly in term premium, also pushing up yields.
That's right where I wanted to go. I'm going to pick on Brian Moynihan. I could be James Dimon or, frankly, any other C-class officer out there. They've got the bright lights of inflation. I got a 256,000 jobs report, 4.1%. I'm sorry, that's a nominal GDP locked in. Do we underestimate the revenue growth that we're going to see a la Delta Airlines, 6% up in business class because Rebecca's flying around the country on Delta.
Well, Delta's great. I mean, if you have to pick one, that's the one to go domestically. Okay. That's my
Every
go-to.
seat's taken.
Yeah, it's true.
I'm on Air France, and they're like fist fights.
Exactly.
They're all talking in French. I don't know what they're saying. But
so what are we doing here? I think for the equity markets, one of the concerns is, boy, we really have to, if we're not going to get a rate cut until October, then boy, earnings really come front and center to support this market. Is that a risk issue for you?
Yeah, because again, there's a smaller and smaller chunk of the consumer that's holding everything up, right? The lower end consumer we know is hurting. So you need the upper middle class and the upper income consumer to continue spending. They can. They have the jobs, they have the income, they have wealth creation from housing and equities. Do they have the confidence and willingness to keep spending? And that can change quickly. Right now, it looks good.
But with a nominal GDP, I mean, where would you model out nominal GDP? I don't want you to do it because I know you're not doing it because you're on this wonderful garden leave. But if you had an Excel spreadsheet in front of you, you've got to model 4.8%, 5%, 5% plus nominal GDP, right?
Yeah. No, it's hard to get bearish on equities in that environment. Again, the question is, given valuations, where do you go? And the other thing, beyond just the consumer and the job market, think about tech, right? We know, forget about NVIDIA. The rest of the Mag 7 this year, next year are going to be spending $250 billion
the Microsoft $80 billion number last Friday.
Exactly. And that's money that's going into the economy, also supporting this big nominal GDP number.
One of your family members calls in, Tom, lose the jobs report. Talk to her about the dollar. Dollar call from Rebecca Patterson.
I think we have another strong dollar year. The thing I'm focused on really is the Chinese renminbi. They intervened today to try to slow the depreciation. They need to depreciate, but if they depreciate in a Trump administration, he's going to come right back at them. And so what do? They have to stimulate the consumer. That is their only way out. And so far, President Xi is not willing to give on that.
Can you model a vector of depreciation back to where they were with weakness pre-2005, I think it was? That's a big move.
That's a big move.
I'm trying to make some news
Look,
here.
in 2018, the renminbi fell 10% against the dollar during the trade war. Most economists and strategists I'm talking to think that is very likely to happen again. So here's your headline. The Chinese renminbi, if the PBOC, if the central bank lets it, is going to fall 10% or more this year. The question is, will they allow it? Are they going to avoid capital flight worries and prevent it? Or are they going to do it because they need it for exports, they need it for manufacturing?
Did you change your outlook at all, just real quickly, with this new administration coming in?
I want to see which policies get pushed forward first and the size. That matters so much to me. So I think we're all going to know a lot more probably by early February.
Thank you so much for coming in today, Rebecca Patterson.